Hi, welcome all. In this today tutorial, we are going to discuss about the income statement. We all know income statement is a statement which show a company's total revenue and expenses for a specific period of time. So which show a company's profitability, revenue structure, cost structure and many more. Anyway, we'll move into the video.
Hello, welcome to all. In this today discussion, we are going to discuss about the income statement. We all know income statement is a statement which show a company's total revenue and expenses over a specific period of time. So first we'll start with what is income statement. Income statement is a financial report that outline a company's financial performance over a specific period of time. For example, monthly, quarterly and annually. The key objectives of income statement is to show whether the company is generating profit or incurring a loss. That means income statement or profit and loss account which shows a company is generating profit or incurring a loss. Also, it helps track financial performance, which highlights the revenue, cost, and expenses to assess how effectively the company is operating. That means the income statement which show a company's performance. That means its revenue and expenses over a specific period of time, which help companies to assess its revenue, cost, and expenses to assess how effectively the company is operating. The key elements in income statements are first one, revenue or sales, which is the top line coming in the income statement, the cost and other expenses, and the net income. So the basic income statement will be the revenue minus all the costs. This is equal to net income. That means we have to reduce all the costs and expenses from the revenue or the sales to calculate the net profit or net income. Here is the structure of an income statement. The first one, when the top line, obviously it is sales. Sales mean revenue, how much revenue company is generating from its core business activities. That means through its sales of its product or services. So the second line will be cost of goods sold. Cost of goods sold mean what is the cost of that sold goods? That is cost of goods sold. That means if you are a trader, you are selling a product at the rate of $10 for an example. So you have a cost of the similar product is $6. So your cost of goods sold in this case is $6. So the gross profit obviously is the revenue minus cost of goods sold. The operating after the cost of gross profit, the operating expenses will become. So once we deducting the operating expenses mean the salary of the employees, other all operating expenses to generate this revenue or to operate the business. So that you have to reduce from the gross profit. So you will get the operating income. So the operating income the formula is gross profit minus operating expenses. You have to reduce all operating expenses to calculate the gross operating income. So after that, you have to adjust other income and expenses. Is there any other income or other expenses is there any income you have to add with the operating profit? And also, is there any other expenses, maybe the financing expenses or any other expenses that you have to reduce from the operating profit to calculate the net profit? So here the net income formula is operating income plus other income minus other expenses. So this is the net income formula. So this is a basic structure of the income statement. Most of the organization follow. The top line will be the sales or revenue. You have to reduce cost of goods sold from the sales or revenue to calculate the gross profit. Then the operating expenses will come. You have to reduce all the operating expenses from the gross profit to calculate the operating income. Also after that, any other income and expenses has to be adjusted with the operating income to calculate the net income or net profit. So this is a basic structure of income statement. So here is an example of income statement to deeper understanding. So this is an income statement of a company or an organization. So here in the top line, it is revenue sales. That means 500,000 is the revenue. After revenue, the cost of goods sold is 200,000. So to calculate the gross profit, you have to reduce this 200,000 plus this from this 500,000. So it is 300,000 is the gross profit. Once we calculate the gross profit, we are coming to the operating expenses. So first one is salary, rent, marketing and advertising, utilities. So here the total operating expenses are 105,000. 50 plus 30 plus 20 plus 5. So we are going to calculate the operating income now. So you have to deduct this 105 plus this from this gross profit to calculate this operating income. Okay. After the calculating operating income, we have to go with the other income and expenses. Here we have an interest income is 3,000 and also an interest expense is 4,000. So in the other an income expense is the expense of net of 1,000. It is an expense. So in this case, the net profit is 195,000 minus 1,000. It is 194,000. So this is an example of an income statement, a sample income statement for a deeper understanding. So now we'll go to the importance of income statement. How important the income statement? The first one assess the profitability over a specific period. As we discussed, the income statement which show a company's total revenue and expenses over a specific period of time. So basically it is assessing the profitability of a business or an organization over a specific period of time, which help track revenue and expenses, revenue and cost management. That means which recording all the revenue and expenses over a specific period of time. So the management can easily track the revenue and expenses for the specific period of time through the income statement. So which is helping the tracking the revenue or analyzing the revenue and the cost management, providing data for informative business decision making. So it is a key income statement to show a company's performance. So it is providing data for the management to make an informed business decision related to future. It demonstrates a company's financial health. So obviously, a company is generating more revenue, also the more profit. Obviously, it is a good sign of financial health. If it is generating the losses, it's a bad sign of financial health. So the final income statement help the companies to demonstrate or to analyze the company's financial health, which is virtual for investors evaluation and decision making. Obviously, the investors or the decision makers, they are looking into the income statement to assess a company's performance during a specific period of time to make various decisions. Like investors, even creditors, customers, they are also looking for the company's performance to establish a good relationship with this company, which is required for a tax compliance and regulatory reporting. Obviously, the government and regulatory and tax authorities are looking for the financial statement. The income statement is the major one. It's to submit the tax or to calculate the tax liabilities of a company. So the regulatory authorities are monitoring the company's income statement to tax compliance. It is facilitate performance comparison. Obviously, it is facilitating performance comparison. That means if a company have a income statement which can be compared with the past years or the industry standard or the similar companies to assess the performance and to make a comparison with the industry standard or the with the previous years. So we obviously which is helping the companies or the management to make various decisions, also to assess the performance and to track the performance. Guide future financial planning and budgeting. Obviously it is a official income statement is a official record of the company which show a company's growth potential and the cost structure, profitability. So also the budgeting, the current cost structure, the for the future budgeting, the company can depend the income statement to see what is the current cost structure and what is the changes they are planning for the future. So they can prepare a budget of the cost structure based on the income statement. Also which help manage cash flow and cost control. Also it is a tracking of all the cost related to a company during a specific period of time. And also it can be assess the cash flow. For example, is company generating more revenue, obviously which is can generate more cash flow. So all these analysis and the cost analysis can be happen through income statement. We will go through an example for preparation of income statement. First one, so here is a practical example to prepare an income statement. So here is a business case. There is a sales revenue of 500,000. So the cost of goods sold in this case is 200,000. There is a salary or operating expense of 50,000. Also the rent of 30,000. The marketing and advertising expense of 20,000. Utilities expense 5,000. Interest income, there is an interest income of 3,000. There is interest expenses of 4,000. So this is a business case or a case to prepare an income statement. So we'll see what is the income statement, how we can prepare the income statement of this. So this is the income statement prepared based on that data. First we started with the revenue or sales, and we are reducing the cost of goods sold from the sales to calculate the gross profit. From there we are calculating all the operating expenses, and that is 105,000 is our total operating expenses. So we are reducing the operating expenses from this gross profit to get the operating income. After that we are adjusting other income. There is an interest income that we are adding with the profit, and also there is an interest expenses we are reducing from the operating profit. So the net will be this 195,000 minus this 100,000. So this will be the net income. So this is an example of an income statement, how we can prepare an income statement. So in this discussion, what we discussed, what is income statement, which is a financial report that summarizes a company's revenue, cost and expenses over a specific period of time. So this is income statement. The structure of an income statement, it first one is start with revenue or sales. It's reducing the cost of goods sold from sales to get the gross profit. From the gross profit, it is reducing operating expenses to calculate the operating income. After it is adjusting all other income and expenses to calculate the net profit. So this is a structure of an income statement. After that, we have discussed the importance of income statement, the assess the profitability, financial health evaluation, inform business decision, investors insight, tax compliance, performance benchmark. So this is today's discussion core concept. So today what we are discussing is income statement. So thank you for watching this video. All the best.